Okay, here's one more question we're going to do. This is notes receivable. A little bit different than accounts receivable. With notes receivable, you are going to be accruing interest. Typically with accounts receivable, it's due within 30 days and typically there's no interest involved. But with this particular question, it says Mini Microphones accepts $20,000, 6%, 90-day note in payment of a past due accounts receivable on June 1. Record the journal entry on June 1 when that note receivable is put on the books and calculate the maturity date and then what journal entry would occur when that that notes receivable is paid off. And so I have an example very similar already set up here. And in this one we have on May 14th, Celeron Company accepts a $6,000 5% 90-day note in payment of a customer's past due accounts receivable. So we have a customer who has an accounts receivable with us, right? They came in, they purchased something, we debited accounts receivable and credited sales when that accounts receivable went on our books. Now what's happening is the customer's called us, or we've called the customer trying to collect on this account, and they're telling us they cannot pay us within the normal 30 days that we give them. And so we've agreed to extend out their due date to 90 more days, but in doing so, we're telling them that we want 5% interest. And so one of the first things you have to be able to do is to calculate what date they're going to owe you this money, right? Because they're going to owe you this $6,000 after 90 days. And so you have to be able to calculate the maturity date. So it's a 90-day note, right? Number of days in the note tells us right there is 90. And then what you have to do is the first month, which is May, you have to take how many days there are in May and subtract out the note date. And that's how many days you count for that month. So in May, there's 31 days, right? So 31 days for May minus 14 because that's the date the note was signed. And that is going to tell you how many days you count for May. So 31 minus 14 is going to give us 17 days that we count for May. And then you just keep on going throughout the next 3 months until you get to 90 days. Once you get to 90 days, that is your maturity date. Okay, so for June, June has 30 days in it. And so now I'm up to 47 days. So I haven't reached the 90th day yet. So I keep going. July has 31 days. And so now I'm up to 78, right? 17 plus 30 plus 31 gives me 78. And then you kind of look because you know that August has 31 days. You don't need 31 more to get you up to 90, right? Because that's the number of days in the note. So how many days do I need to get me up to 90? I've got 78 already. So I need 12 more days in August, right, to get me up to 90. And so the maturity date on this note is going to be, oops, sorry about that, guys. I don't know why that popped up. Is going to be August 12th. Okay, whatever this last date is that you have to plug in to get you up to the number of days in the note, that is the date that it's going to mature. So once you've got 90 here and it agrees with the number of days in your note, whatever the last number is here for the month that you have, that's the date of the maturity. The most particular thing is, first off, knowing how many days there are in each month, right? So you might have to pull out a calendar or pull your phone out and look at your calendar on your phone. And then the next most important thing is not to forget to subtract out the note date on that very first month. So again, May had 31 days, so that's where the 31 is coming from. Minus 14 because the note was signed on May 14th. So we only count 17 days for May, not 31 because we can't collect interest on the days that we didn't have the note. Okay, so now that we know that the note's going to mature on August 12th, that's the day they're going to pay us the $6,000 plus the 5% interest that they're going to owe us. What journal entry do we need to make on May 14th to take this accounts receivable off of our books, right? Because what we're doing is we're substituting this note receivable for this account receivable that they had before. And so they're both assets, right? Accounts receivable is an asset and notes receivable is an asset. But one of them is going down and one of them is going up. And we know from prior chapters, if we're trying to increase an asset, you have to debit it. And which one is increasing? The notes receivable is increasing. So I'm going to take that $6,000 and I'm going to put it in my notes receivable, right? A debit to notes receivable increases that account. And I'm trying to decrease my accounts receivable because now they no longer owe me on account, now they owe me on note. So I'm going to decrease my accounts receivable with a credit. Again, both of them are assets. My notes receivable are now increasing, accounts receivable is decreasing. I'm just substituting one for the other because now I have interest involved. Okay, so what happens now when the note matures? What do we have? What journal entry do we have to make on our books when Celeron Company pays us the $6,000? But they're not only going to pay us the $6,000, they're also going to pay us 5% interest. So not only do you have to know how to calculate the maturity date, you also need to know how to calculate what is 5% of the $6,000 over the 90 days, right? Because 5% is an annual interest rate, so they're not really going to pay us 5%. They're going to pay us a portion of the year's 5%. So the formula to calculate interest is principal. Oops, it should be equals. Principal is P stands for principal. That's the $6,000. That's the amount that they owe us. That's what principal stands for. Times the annual interest rate, which was, in this case, 5%, times time. And time is typically expressed as a function of months, years, or days. All right, so let's calculate this interest. We know the principal is $6,000. We know it's a 5% annual interest rate, and the time is 90 days, right? Since the interest rate is an annual interest rate, this time has to be also be listed as an annual amount. So since this is 5% annual interest rate, but we only have 90 days, we need to do that as a function of a year. So 90 divided by 360. And I know that there's 365 days in a year and not 365, but finance always uses 360 when you're talking about calculating interest. They assume that there's 30 days in every month, right? And 30 days in the month times 12 months gives you 360 days and not 365. So again, I know that there are really 365 days in a year, but in finance, for the interest calculation, they always use 360. So now I can just do the math, right? 6,000 times 5% times 90 divided by 360. And if you remember back from probably 4th or 5th grade, the multiplicative property says that if in your formula you have all multiplication, you could solve this going this way, right? Working from 6,000 times 5% times 90 divided by 360, or you could work it from this way and go backwards. I always work from the back and go forward. So I'm going to take my 90 divided by 360, right? So that's 0.25 of a year. That's how long they owe us the interest for. Times 5%, and when you convert that to a decimal, that's 0.05, times $6,000. So how much interest are they going to owe us? $75. So when they pay us back on August 12th, right, they're not only going to pay us $6,000 for the principal amount that they owe us, but also $75 for the 90 days worth of interest at 5%. So we can plug in our date, right? We know it's August 12th. We know that we're going to be getting cash, right? Because they're paying us not only the $6,000, but also the $75 with interest. So we're going to be increasing cash. And since cash is an asset, in order to increase it, you have to debit it. So I'm going to do that for $6,075 because we should be receiving a check in the mail for both the principal and the interest. Now I have to take this note receivable off my books, right? Because now they've paid us. They no longer owe us the $6,000. So now I have to reduce this asset. And in order to reduce an asset, you have to credit it. So I'm going to credit that note receivable for $6,000. So that reduces this back down to 0. And I have to record the interest revenue that I've earned on this note, right? Because simply from the passing of time, I've earned that $75 worth of revenue. And so when they pay it, I have to record it. Okay, so again, anytime you record a journal entry, always make sure your debits and credits are equal. I've got $6,075 worth of debits, $6,075 worth of credits. And it doesn't matter which one of these credits you do first. You could have done interest revenue first and then note receivable second. It doesn't matter. as long as your debits always come first and then your credits. Okay, so that's notes receivable, calculating the maturity date, recording that note receivable on your books on the day that the note is signed, and then recording the money that you're going to get when the note matures and the customer pays.